Happy Thursday, everyone. Welcome to week 3 of Investor's Guide to Thriving. Tonight, I'm joined by some of my favorite people, and we have a really special edition of the show for you. First up, we'll hear from the Managing Director and Head of ETFs and Managed Account Distribution at BMO Global Asset Management, just call him Mr. ETF. Kevin Prinz will introduce you to a fantastic free set of resources to help you pick ETFs for your portfolio. But I have to say, when it comes to investors, there are really two kinds of people, those who are actually interested in them and those who aren't. Now, my background is in psychology and philosophy, which at once have absolutely nothing to do with understanding markets, but also have everything to do with understanding markets. I've always been fascinated by the crowd that watches Larry on BNN because it's such a concentrated audience of people who are pretty passionate about getting hands-on with investments. And that's very different from the average investor who knows they need to invest but has no idea what they invest in, nor do they want to understand what they're investing in. But overwhelmingly, what we've noticed over the years is that those who are very engaged with their investments and their investment choices often overlook the bigger picture, thinking that if you just pick the right investments, the rest is going to take care of itself. And it's often said that those who fail to plan to fail. And it turns out this is pretty true when it comes to investing, because without understanding what you need to achieve, it's easy to take too little or too much risk. And without understanding what the purpose of your money is, what you want it to help you do in life, all you really have is a pile of paper that on its own won't bring you much joy. Now, that's why our group of companies includes U Potential, and why we're so proud to be working with Monique Medan, financial planner extraordinaire, who joins Larry for tonight's feature presentation. And it's really going to be more of a conversation around being able to retire comfortably and how to start making a roadmap from whatever life stage you're at now to get there, and what it'll take in terms of time and investment returns. Monique helps Canadians coast to coast on a fee-for-service basis, where she just provides financial planning services, but also is part of the ETF capital management team for those who want a 360-degree family wealth management service that seamlessly integrates planning with investment and risk management. The former is literally available to everyone, while the latter is best suited for those with investable assets of $1 million and up. And that's also the crowd Monique is most often to help minimize taxes. Over the years that we've been in this business, interest rates have decreased massively, and that's made it very difficult for savers and those who are retired to achieve their goals. Today, real yields are mostly negative, and Monique will explain, when compounded by inflation, that's actually a big problem. Larry will answer this challenge by explaining some of the techniques we use at ETFCM to combat this problem, including how you can use options to enhance yield, constrain equity volatility, and improve returns without taking as much downside risk. He'll also look at what you can learn from pension funds like CPP and university endowment funds like Yale and Harvard, and what they've been doing to compensate for ultra-low rates. Well, it's about time to get the show going. But before we do, Larry and I would like to thank those of you who have joined us in support of research efforts at Sick Kids to find better cures for childhood leukemia, and the Baycrest Foundation, where we support their world-leading Alzheimer's and dementia research efforts. If you would like us to match your donations, please use the links in the survey you'll receive after the event, or visit investorsguidetothriving.com and use the links there. This is how we're able to track and match your generosity. Now, that survey is also your gateway to access the webinar replay, which will arrive in your email tomorrow morning. Tell us how we did, and you'll get a link to access all of the above and submit questions for next week's webinar. Well, now, as promised, I'll turn it over to Mr. ETF. Over to you, Kev.
Oh, thanks so much, Jared, and thanks for the opportunity to have a chance to educate the audience here on some tools that we are providing for free on our public website. So do me a favor, let's just jump right into it. Not a nice, good slide. Let's jump into the actual tools here. And what we're trying to highlight here is just what Jared's saying. When you're talking about investing, you effectively need to do some due diligence. And what we're trying to do here is help you do your due diligence across the board. So these tools are free to use right off the bat. Second, I want to highlight, you can actually do due diligence on 1,000 Canadian ETF listed ETFs, as well as all the mutual funds out there too. So it's all in one nice tool for you. No passwords to get in. I think people love that the best because I can't remember any more passwords if I'm done. So nice and easy to get in. And then of course there's 3 tools here. One, a comparison tool. We'll walk you through that in a second. Second of all, a screener tool. And last but not least, a proposal generator, which is really an asset allocation tool. Let's skip to the next slide if we can, please. So let's first talk about, and I'm going to take you for a little tour after this, but from a high level perspective, let's talk about what you can do with a comparison tool. So let's say you want to compare any ETF to any ETF, or any ETF to a mutual fund, or any combination across the board. Here's a tool where you can actually do that on a side-by-side basis. So one ETF right next door to the next ETF, right next door, and then take a look at a number of different metrics. For example, performance data, like we're showing on the screen right here. But in addition to that, top holdings, you can see what's inside the basket, the trading volume itself. You can see sector breakdown, risk metrics, standard deviation, of course. They even see things like management fee, people on no costs, fixed income metrics like duration, yield to maturity. And then on fund size, how big are some of these ETFs out there, and some geographical breakdown. All of those are key elements in making decisions on which ETF is right for you across any of those 1,000 ETFs out there. Not just BMO ETFs, any ETF. And we'll show you that in the example. Yes, my slide here has a bunch of BMO ETFs on it because you can see the Z tickers on them, but you can do any ETF in this situation. Let's jump to the next slide there, please. Then the second thing you can do, which I think is a real powerful tool, and we'll show you this in a second too, is the ETF screener. Now, what this tool can do for you is, let's say you like a stock. Doesn't matter what the stock is, and maybe an example we'll use later on is like Tesla or so, or Shopify as you're seeing right here. If you want to know an ETF that is overweight that security, here's a tool to do that. So let's say you're watching BNN and listen to Larry, or listen to somebody else, and Larry's talking about a stock, some viewpoint in, and you liked that, but you want to have more of a diversified way of holding that. So not concentrated individual security, but be more diversified. Well, that's where this really comes in, because you're going to get that stock, and then likely stocks like it within inside that basket, and maybe have a more diversified way to get that exposure in your books. Let's go to the next slide as an overview. And this is really the portfolio generator. It's an asset allocation tool. What you do inside there, if you want, you can start off, there's 3 default asset allocations designed for you off the bat. If you don't want to use those ones, you can build your own mix of any ETFs in Canada. Or if you want, you can even start with that basic mix we put together, then remove some and add some of your own mix. What that'll do for you is then show you how that portfolio has performed over time to give you some indication of, is this the right mix for me? Is this the kind of volatility I want in the portfolio? So a tool to really help you build portfolios. All in all 3 tools are really designed, again, to make you a more informed investor going across the board, and free of charge. Last slide there if we can. Yeah, so let's get started. If you want to get started, we got a nice way of showing you how to get there. Do me a favor if you can you bring up the ETF Market Insights website? We just launched this website. I love the look and feel. It's really designed for end investors to give you some key core information in the marketplace. It's etfmarketinsights.com. Can't be any simpler than that. It really relates to a website we run on a regular basis and a webinar we run every Friday called ETF Market Insights. We have 70 shows we've been doing. Each week we cover another topic on ETFs. But what I want to draw your attention to is just take it down the bottom of the page there if we can. Lots of tools for you to look at, blogs, the whole works. But on this page, you're seeing the word ETF tools, little hammer there, of course. Let's hammer that ETF tools button, please. And what this is going to do is show you a bunch of interesting tools that we kind of talked about over the years on the show. But for today, I just want to focus on the ones that BMO provides. There's also a list of all tools from different providers out there too, index providers, that kind of stuff. Let's just scroll down there for a second. There's a red button right down after the picture of the 3 tools. That's going to take you right to the BMO ETF website. We do this just to kind of make it easier to get there. Sometimes sites are a little more challenging to find the right tools, but here they are, the comparison tool, the screener tool, and the proposal generator. Now I'm just going to spend some time, go a little bit of the comparison tool and then the screener, and I'm going to encourage you to take a look at the proposal generator yourself. In the comparison tool, look how dynamic this is. And so do me a favor, for example, there, type ZEM in there. So this is the emerging markets ETF. That's ours, of course. And let's get some flavor in there. Put VEE in there too, please. And then we'll put XEM too, so we can do a a total side-by-side comparison, just so you can do here. Yeah, XEM, the other one, yeah. Perfect. So here's 3 emerging market ETFs. We can do more, do less, doesn't matter. But what you can see is how they line up side by side. Now just click on the one below the fund information ticker right there. Yeah, perfect. There's some core information of what indexes the respective ETFs track. Some key metrics when they first launched, what they're focusing on, their costs across the board. So you've got some key information there. Then click on the next one, the performance. This gives you a snapshot immediately in the current year, and then across the top you can go 3, you can go 5, you can go common inception, which just kind of says when they all started together, and that just shows you how they perform over different periods of time, right? And of course laid out before in a graphic paste too of bars, and just keeps going down one more a little bit here. Perfect. Fund data information. Now you're getting into things like distributions, how often happens, the volatility, being the standard deviation there, right? And assets under management, respective things too. And then market data, quickly close this out. Market data, diff shares outstanding. Bottom line below that, holdings. This is going to be a snapshot of some of the different types of holdings inside these structures. So the sector breakdowns across the board, the top holdings, just give you a snapshot. Now, let's say this is not enough information. This tool is really dynamic. Scroll right back up to the top of the list there. Do me a favor, just click on, in this case, VEE. Have some fun there for a second. No, on the actual ticker there, sorry. The blue ticker. Yeah, not the remove side, but the other side. Yeah, XEM's fine too. Perfect. Brings you up to a one-pager on any of the ETFs in Canada, give you a further depth of information. And last but not least, just scroll down, you can see the kind of holding snapshot of it. So really helping you with that due diligence. And then frankly, one last thing, which I think is a nice thing, scroll up just a little bit from here, please. See the provider right there? It'll actually take you to the respective provider's website too. Don't do that right now. But it's just showing you the dynamics of the tool across the board. Can you close out this, and let's just take a little tour of the generator, the screener. Thank you very much. And again, what the screener is really trying to capture for you is that trend where people are moving to ETFs over top of stocks, but still being, more precise, but diversified at the same time. So it's just put on the stock replacement tab right there. It says stock replacement right there. Just type in the Tesla, for example. I know everybody talks about Tesla these days, so just put that in there. Yeah, either the name or the ticker, doesn't matter. Boom, great. And then just scroll down a second there. Perfect. Here's all of the BMO ETFs that are overweight Tesla. Of course, we're going to list BMO first, but scroll down even further. Here's a list of all the ETFs that are overweight Tesla. So there you can take, if you want to go from here and go to the comparison tool, notice on the far right, you can even do that too. Don't do that. You can have some fun and play in there on stuff, but you can start to see how you can use this tool to really be a key element in your evaluation of ETFs, your finding the right ETF that meets your needs, or last but not least, generate that portfolio around ETFs. I encourage you to take a look at it. Take a look at ETF Market Insights, and then again, that hammer button will take you right to this side. And that's all I have for you today. I'll hand it back to you, Larry. Thanks for the opportunity.
All righty. Well, thanks very much, Kev. And once again, you can tune in Fridays at 1 o'clock to the Market Insights webinar for additional help with your portfolios and insights into what's going on in the ETF world. I think, Kev, all the tools you guys are building, you're going to take my job away here. People are going to stop calling in and asking questions about ETFs on Berman's call, because you guys have provided such an excellent suite of products. Jared mentioned at the top of the webinar today we have a very exciting guest, and we certainly do. You know, as someone who's been a professional investor at various different aspects of the market, from sales to research to portfolio management to being a commentator on TV and an educator, I in my 35 years, I'm in my 35th year of the investment industry. Started out selling mutual funds while I was in university in the mid 80s. And I'm not lying when I say the most important aspect of the investment planning is nothing to do or very little to do with what I bring to the table. And it has everything to do with what our guest brings to the table tonight. I'm so excited that Monique heads up our U Potential business, and in particular because she's just a great person to know. And so, you know, she's a specialist, of course, in financial planning, dealing with very difficult situations in terms of divorce. Sometimes those are very complicated situations. You're going to have the benefit tonight to ask some questions to Monique and myself. We're basically going to have a conversation tonight about a lot of things, but everything that comes up to how should I invest my portfolios? All the questions we tend to get are, you know, should I buy this or this? Is this right for me? Is now the time to do it? And I think it's because people don't have a plan. People don't understand, as Jared mentioned, what their goal is. And so I think Monique and I structured this talk tonight to take us through sort of saying, depending on what life stage you're at, 30, 40, 50, in retirement already, how should you think about your portfolio? What do you need to do to meet your goal? And really your goal is, to me, is about making sure that your standard of living is you're in your working years where you've got a lot of income, hopefully, to the years where you've stopped working and now you're at the mercy of your savings and what the government provides for us in our older ages. And one of the things that we'll look at a little bit tonight is the demographic outlook, because as we all age, we're all living longer, and that presents some financial problems and challenges as well in terms of delivering a safe retirement. So that's our conversation tonight. We'll have some ideas for you. At the end, I'm going to talk about some of the strategies that I use to select ETFs, how we go about adding them to the portfolio when we take them away, individual securities. So there's still going to be a lot of that tonight. But the important part of tonight's discussion, and as I welcome Monique into the conversation tonight, is really about what she does. So welcome, Monique, and so happy to have you with me tonight.
Oh, thanks, Larry. It's a real treat to be with you.
So let's dig right in and let's look at the average. So tonight's conversation is settled around the average Canadian family, not the median, but the average. And we were able to get some numbers out of Stats Canada. And so as it turns out, a family, the national average per person, so per income earner in a family, is $61,600. And what I would ask you guys to do at home is think about the averages and then where you fit into that. Are you above? Are you below? Or is there two of you? Is there one of you? Do you have kids? You know, that kind of thing, because we can't possibly cover all the different permutations and combinations that are out there. So we are talking an average. If a family that has two income earners earning the average, so about 120,000 with zero savings, that means their lifestyle costs $90,000 per year. So talk a little bit about why this is our starting point, Monique.
So what I did was I created some modeling to try to figure out, I mean, if there's one thing that most people don't know, it's what they're spending. And really the only way to know how to support your retirement lifestyle is to know what that lifestyle is going to cost. So I did a simulation using, like you said, the national average, which comes from the yearly maximum pensionable earnings. and worked backwards, kind of reverse engineered. If someone is, like you said, perhaps 2 income earners earning that amount, they're not saving, which means everything is being spent. Likely they're spending about $90,000 a year. That gives us a starting point from which to say, okay, if we want to support that lifestyle indexed for inflation, how much do we have to accumulate before we retire? And then how do we draw it down? And that's how we created these models to show at various stages of life, at various rates of return, how do we get clients to where they want to be?
Okay, so we're going to look at different life stages, and we're going to look at different abilities and willingness to take risk, right? So on this graphic, we have someone who's starting at age 30. So for you guys out there who are already at this magic number, think about your kids, because you're going to know someone, and whether it's you or your kids or you're somewhere between that, okay, we're starting to work and we maybe have a little bit of savings to put to work, and to the age where you're thinking about not working and that money's got to last you for the rest of your days. So if you're not able or willing to take a lot of risk in your portfolio, in order to maintain that average lifestyle, right? So that family that earns $120,000 a year and has spending of 90 and has no savings. So if they have no savings, Monique, how are they going to reach these numbers?
We're going to get into it, I'll tell you.
Right, and so that is the question, and it becomes tough. So if you're very risk intolerant, right, and these numbers are accounting for an inflation rate of 2.5, we'll talk about what if that number's bigger in terms of inflation towards the end. This is the amount that you need in your nest egg at 65 if you want to maintain your lifestyle at that level of spending, right?
That's right. And so the trend that this table shows us is that if on the left-hand side, if you're only willing to assume risk that would produce, let's say, 2.5% per year as an investment return, you're going to need very near, what is that, $4 million by age 65. Again, we'll talk about how a 30-year-old accumulates $4 million over the course of 35 years, but let's focus on this first. And then you see a trend that the more risk that you're willing to take, naturally, the less capital that you're going to need, because you'll be generating that return to support your standard of living at 65. Looking at the trajectory then, if you, let's say, look at a more ambitious rate of return, 5.5% only requires $2.5 million at age 65. 8%, which I'm even reticent to talk about, probably requires maybe $1,750,000. And then, if you really want to go from the difficult to the absurd, which you'll get into later, a 12% return, you could probably support a $90,000 standard of living at 65 if you've accumulated $1 million at a rate of return of 12%. So
okay, but
clearly
so wait a second, Monique. So wait a second. You're 65 and you've got $1 million, but in order to maintain your life, you need to get 12% a year? Or you're going to run out of money before you
Right.
Oh,
and
wow.
if you're not willing to take 12%, let's say 8%, you better be willing to save more to accumulate that extra $750,000 to make up for the fact that you're not going to produce the investment return. That's
So
exactly
I think
right.
the key takeaway then here is, Monique, is you need to think about the you at 65 and what kind of lifestyle that you want to live in retirement. And that should really dictate how much risk you need to take today, again, based on how much you can start saving. But I think the numbers of the average Canadian and what they're able to save based on their incomes is actually not a lot.
It pales. That's right. That's right.
Yeah. So what are we looking at here? You're saying, okay, so those were the 30-year-old numbers. What if you don't really start until you're 40 or 50?
Right. So we've translated those same numbers are the gold bars. So the 4 million, 3 million, 2.5, et cetera. Now let's layer in what happens if a 40-year-old is starting to invest. Again, earning the national average, so between the two spouses, probably in the $120,000 range combined. And to date, be it because of lifestyle choices or circumstance, they haven't yet been able to accumulate anything. So they're really starting from zero. A 40-year-old needs to accumulate $3 million at 2.5%. A 50-year-old in the gray needs to accumulate 2.5 million. And so you might ask, well, that doesn't sound right. Why, if I'm starting later, do I need to accumulate less? And I'll get to that in a second. But in terms of, again, the trajectory of this particular analysis, it just shows you again that if you're willing to take more risk or you're lucky enough to produce those rates of return, you require less capital at age 65. So as you can see, the bars become lower the more risk you're likely to take. Do you want me to get into why it is that? Oh, we'll get into that later. No worries. Go ahead.
Well, so this next chart here, this is the ugly one, or one of the ugly ones, because it shows you what that savings needs to be at those levels of risk to achieve those goals.
That's
right.
Right.
When you're 65. And you have a point here that the average savings in Canada per household, per person, is that per person is under $6,000 a year. Now, averages can be misleading because you got a whole lot of high income earners where those savings numbers are much, much bigger. And so you're looking at maybe the top 10 or 20% being able to save well more than they need, but the bottom half certainly maybe not even close to those numbers.
Not at all.
Averages are averages.
And that's actually a very recent number. And it was only supported, it's substantially more than it was in previous years because, of course, there was a lot of government stimulus that with nothing to buy. So lots and lots of people increased their savings and their investing through the pandemic because of the government support. So that's not going to be the case going forward, unfortunately.
So if you're a risk intolerant 30-year-old, I don't know any, by the way, but if you are, you need to save 17,000 and change a year.
That's right.
In order to meet that goal. Now, of course, if you're a Bitcoin risk-seeking 30-year-old, you only need to save $2,000 a year.
Right. That's right.
Okay, yeah. So really, again, that rate of return is important.
Yeah.
One of the things we're going to look at a little bit of is one of your roles, and that the rate of return that comes from investments, but it's really after tax. And so there's a lot of ways to invest where your return can be higher and benefit from some tax benefits too, right?
Absolutely. So if we're
Obviously,
looking at those,
keeping fees lower is a way to increase that return to you as well.
Right, right. And if you're looking at those phenomenal goals of $4 million, $3 million, where you're starting from nothing, yeah, you can moderate those considerably by using tax efficiencies as well, RSPs, TFSAs, and things of that nature, for sure.
Right. So this graphic you prepared too is a bit of an eye-opener. When you think about, well, what is that money in future dollars? So that 30-year-old today, when you think of that 90,000 your family spending, that number adjusted for 2.5% inflation is going to be 214,000 per year.
Right.
And that's why that 4 million number, that's why you need a lot of those bigger numbers there.
And that's what kind of counterintuitive, right? When I mentioned it earlier, why would a 30-year-old not willing to take a lot of risk have to save, let's say, $1 million more than a 40 or 50-year-old? And this is precisely why, because a 30-year-old who's already spending $90,000 a year, or I should say more precisely, a couple already spending $90,000 a year with no savings, it's awfully hard to get out of those habits once you've set up your standard of living. People are very reticent to reduce their standard of living. If anything, we see the inflation of our standard of living when we earn more. But someone who's 30 earning, like we said, spending $90,000, they have to support a $214,000, let's call it a habit. That's really what it is. Your lifestyle is a habit. Whereas a 40-year-old at that level, 25 years hence, that number is only $170,000 a year. So that contributes significantly to the target amounts that, quote unquote, what's your number discussion we were talking about before. It's the fact that someone used to spending, or a couple used to spending $90,000 a year. That's what they're going to want to do when they're 65, and they're going to have to cough up $214,000 to do it.
Okay, so the big question you got to turn to me is, how do we get these numbers? Like, what kind of investments, right?
Show me, show me the way, Larry, because those 8 and 12%, they scare me.
Yeah, they do. So here are the facts, right? So I've put together a couple indexes here, and don't worry about the acronyms on the tickers. These are Bloomberg specific tickers, and you may not find them anywhere else, but they're major indexes. So the first one, LEGA there, that's the entire world bond market. And we're looking at data here monthly from the end of September going back 30 years. Okay, so we're going back to 1990 here. And so that entire fixed income world, 5.5%, 5.49, that's the annualized return. No fees, no taxes, no nothing. That is the gross return on your money. And you might say that's a gross return. So historically, the fixed income side, and we've been in the biggest bond market, bull market ever, right? If you actually look, Monique, at a 30-year rolling window going back 100 years, where we have data for big financial markets, largely from the US, but big financial markets, and you look at the best 30-year period of returns ever, that was it. We've already seen it,
Yeah.
right? It's not the go forward, that was it. And so when you look at the next index, MXWD, that's the MSCI ACWI, All Country World Index. And that number, 7.5%. So all the stocks in the world together, if you could buy them in one ETF, guess what? You can today for a very low cost. That was the historical number. If you take the Russell 3000, the biggest benchmark in the US that has the S&P 500 and 400 and 600 and part of the Russell 2000, this index, all the US stocks, 10.36. Again, best 30-year window, going back, rolling window ever. So you've just completed the best 30-year period of stocks and bond return globally. And if you think about a 60-40 balanced portfolio for the average person and their level of risk, the entire US bond market, 5.82, the TSX, 7.8. So again,
Larry, do you mind my asking you a question?
Sure.
So when clients do come up and they say, can you do a simulation using 8 or 12%? What are they referring to? I mean, where in their experience would they have seen these types of returns?
Well, we show them the door and say, sorry, we can't do that for you, because the history, unless you're willing to take all equity risk, right, you can't come anywhere close to those numbers. And this is the challenge, because today, Monique, 11,000 people in the US turn 65. The baby boom from post-World War to the mid-60s, you do the math in the middle of there, 65 is 2021.
Wow.
All right. So you have that boom generation, which I'm on the tag end of. I don't think you're quite there yet, but you're thinking about that retirement scenario. I'm 56 right now, right? My wife's
yeah, she wouldn't want you to mention it.
No, she's a couple of years older. But so we're at the tag end or middle of that generation. And so now we're thinking about that scenario, right? And how do you get that number?
Yeah.
So someone's asking if this includes CPP and OAS. And so part of your return could include those numbers, right?
So the numbers that I've factored that into the standard of living that you can support.
Right.
But when we're talking about $90,000 a year in expenses, yes, it would include a CPP factor. Remember too, old age security is income tested, so it's kind of a slippery slope. The more you earn by way of capital and the more you actually earn by way of annual taxable income, conceivably you could be collecting less OAS later on. And especially if you ever want to talk about dividends, those can be adversely affecting your OAS as well.
Right. So those are considerations. Listen, this is why, these are great questions. This is why you need to sit down with someone like Monique and run the numbers. Like if you're capable of doing them yourselves and you have the software to do them, by all means, but do the exercise.
Yeah.
And a lot of financial professionals will do the exercise for free and then they'll sell you mutual funds. And there's nothing wrong with that, but that's the way that planning process tends to work. Or you can work with someone like Monique who charges a fee for planning, and then you're off on your own to do it yourself, right? If you want to do that, or you could choose to work with an advisor. It's up to you.
Yeah.
And if that's something that my firm can help with, I think we'd be glad to look at your situation. But so we've been through the best 30-year period in history, and we can't do that unless you're all equities.
Right.
And given where valuations are today, it's a challenge. Now you might say, well, that's the last 30 years. What's the longer term number? The longest term index we have is US large cap, and we can measure the Dow or we can measure the S&P 500, similar numbers. It's 9.7, right? So equities will tend to grow at approximately the rate of nominal growth in the world. And what I mean by nominal is the real rate plus inflation.
Right.
That tends to be what, when you package it all up, what equities will deliver as a nominal rate of growth, plus whatever leverage gets into the system. So the more spending there is by way of credit creation, that's the business cycle. The credit goes up, credit goes down. That's a big swing factor. So the more debt there is, the more credit there is, those numbers can be a little bit higher in terms of the pure nominal growth rates of the economies.
Right.
So that gives you a good guideline. But
and it still doesn't come up with 12%.
It still doesn't come up with that bigger number. Now there are smaller periods. I'm measuring from 27 here. Monique, if I measured from 32, which was the bottom after the Great Depression and the Great Crash of 29, this number goes up to 2% a year, right? So
by 2% a year.
By 2% a year. So it depends where you start and measure. But if you're the unlucky person that retires at the top of the next bubble, right? And has to go all equities, you know, that's a chance. And they talk about the safe withdrawal rate. What is the amount that you can take out of your savings in your portfolio to make sure your money lasts? And then that number is lower and lower. So this slide is about the go forward, because it doesn't matter about the rear view mirror. If you're sitting with someone and they're modeling what just happened and telling you you're going to get that, I'm not sure about that. Okay. So let someone asked about, you know, owning your home. We have a slide on that coming up. We'll get into that in a minute, because that is part of the factor too. So financial FP Canada, right? Financial Planning Standard Council of Canada, FP Canada, has guidelines, and they put them out to financial planners like yourself and say, you know, conservative investors, these are the numbers you should model for the next decade or so, right? Those are kind of the guidelines.
Yeah, essentially, they want to create consistent reporting so that from a perspective of the planning community, we're not vulnerable to any you know, market sway or anything like that. Let's use across the board for projections purposes some standardized rates of return, because very often when people are working with the planner, I'll produce a 40-year projection. You definitely want to have conservative and defensible rates of return that you're basing your life decisions on. So these may feel viscerally a little bit conservative to many, although they are quite realistic because they're based on 40-year returns going backwards. Even though they may feel a little bit conservative, better to be conservative in this particular situation because, again, you might be making decisions on what to invest or whether to purchase a second property and all these things and how it'll ultimately affect your retirement, you know, a generation ahead from now. So that's why we use sort of across the board, financial planners use rates of return. These aren't exactly them. I kind of made them a little bit easier to digest by rounding them off, but it's a fairly good starting point.
So growth is what, an 80% equity portfolio or more?
It might even be 100% equity portfolio. I presume that there's an aggressive growth component opportunity as well. So I would say a growth portfolio might be 100% equities, but you know, with many that are more income producing rather than growth oriented.
Gotcha.
So a little
some
bit more conservative.
dividend yielders, utilities in
Right.
there. Yeah.
Right.
Okay. So not like all technology. Okay. And
Right.
balance would be your typical 60-40
It
stocks
would be
to bonds.
your generic 60-40. That's right.
Right. And conservative would be what?
Maybe a very conservative portfolio, which this probably would not be resembling, might be a 20% equity allocation. My guess is because of the return on investment that's shown there, that's probably more of a 35 or 40% equity.
Right, equity to bond.
Yeah.
Well, the entire yield of the fixed income world now is 1.5%. I'm just saying, like, I question these numbers because if 40% of your return is 1.5, forget fees or anything else, right?
Right.
Your equities in order 60-40 to deliver 4 needs to be close to 10.
Just to make up for the fixed income component.
I do question these numbers, but anyways, these are the guidelines that people are planning with. So the graphic here is from the Research Affiliates website. I should have put the link on there. I talk about these guys all the time. They basically take all the asset classes in the world and they say, what is that average real return going to be for investors, you know, looking out 10 years? And I will want to fix your eyes on the 60-40 number that is slightly below 0 in terms of real return. So again, after inflation, and just below 10% in terms of volatility. So the average 60-40 portfolio for the next 10 years, those are real numbers. So let's say inflation is 2.5. So it's say now 2%. So this looks like it's at -0.5 or something like that. So they're saying 2% as opposed to 4, but it's low. It's a small number.
Yeah.
Right. And that's speaking to the low yields in fixed income and the high valuation in equities. Right. So when you look at this graphic and you say, well, where in the world, now again, forget the rear view mirror, going forward where the returns might be higher. So EM equities. So that's up around 6-7% with the standard deviation, the volatility of 21-22%. So you've got the best returns, but with way more up and down, way more standard deviation to your returns. EFI, that's international market, stands for Europe, Australasia, Far East. Again, pretty decent numbers. Look at US large caps. That red number, that red bar right in the middle of the chart, below 0. So the S&P 500, that's what that number is. Right? So you've got a real big challenge to passive investing. And I love ETFs, folks. I love ETFs. I called my company ETF Capital Management for their effectiveness and ease to build portfolios with. And I love them and I still love them. But the passive return is going to be challenged in the world we live in, at least for the next decade, and we'll see how it goes. But after a market correction, that's when the opportunities are really there. So we'll get into that a little bit more. So what are we looking at here? So these are StatsCan numbers that are the average net worth of Canadians at 65. based
Right.
on
So
the recent numbers.
correct. So the last census showed that the average 65-year-old has a net worth of under $1 million. So never mind all the statistics we showed
Again,
on
this
8%
is average because a lot of people
average.
have 10 million or 20 million, which means the
And just
median
as
is,
many.
which means is the median if you don't own your home, right? This includes your home equity, right?
That's right.
Yeah, so if you don't own your home, someone asked about, well, this you're not factoring in the house, right? Listen, that's part of the individual financial. Some people don't have a
Right.
house. So you gotta look at your individual
And
situation
more
again.
often than not, by the way, when I'm simulating the plan, I ask clients, is your home conducive to living in when you're a little bit older, when your knees start to fail and things like that? And when they talk about that, they say, oh yeah, no, I'll downsize. And we say, well, is the downsized home going to cost less? And in major urban markets, condos and one-level housing is not going to cost less than your suburban two-story homes. So there's a lot to contend with in terms of the home, not the least of which is the fact that you may not be able to take money out of it until, a very ripe age.
So right, so when you're 80 or 85,
Right,
and then you sell
right.
your house, like, do you really want to leave your house and move and downsize? So
No,
that, again, individual question,
right,
not necessarily, you can talk about averages, and that's why, again,
right.
thinking about what you need and what you want down the road is really important. It's really the critical part of figuring out how you need to invest. I think it's so important.
Yeah.
So, should you be taking a 12% goal? Should you be targeting 12% at 65?
Well,
Right? Like,
what would you say in terms of the philosophy of the sequence of returns? You
well,
could do great
so
in a particular year, but
well, you had shown that in your accumulation years from 30 to 65, had you got to 12 and saved, again, this is not investable assets. You don't get a yield off your house, right? You
right.
can't live off that piece. What's the average house price in Canada today? 600-ish?
Yeah, phenomenal. I would have expected it to be far lower, but yeah, this is
And
a national
and
average.
the national average of a housing price, but what's the equity component of that? 20%, 25 maybe?
I would insist maybe nationally it would have to be 20% because that's where the insurance company will. Sorry, I'm missing out the acronym
Yeah,
off the top of my head.
CMHC is
CMHC,
the
exactly.
insurance, yeah.
They use 20% as being sort of the high leverage point, the high risk point. So I would have to think that there's a little bit skewed beyond 20%,
Right.
but my husband and I will be mortgage free next month and we're really excited. I think we're probably of a minority in Canada about that, especially, I'll be 50 this year. So there's lots of people retiring with mortgages, unfortunately.
So how can financial planning help people achieve their goals?
Right. So unfortunately, I can talk until I'm blue in the face about the fact that financial planning goes well beyond budgeting. But when people think of financial planning, they think of budgeting. Really, what I'm working on is I don't want you to spend any less than you do now, but I do want you to know what your affordability parameters are. So if you are in the group of earning, let's say the national average, 90,000 is not going to provide you any room to save. We established that. So, I'll talk about metrics in terms of coaching the clients as to what an affordable lifestyle would be, and then they can decide how they do it. I don't care if they go and buy coffee every day. I don't care if they, lease their cars. You decide how you spend your money to make the best life for you. But knowing the upper limit will at least allow you to, in most cases, decide between things that are most important to you. Beyond that, that's just the budgeting side. Beyond that, we will look at, are there ways to optimize so that we can free up money for savings? Very likely on the tax planning end. We're talking
Right.
here about extreme returns being 8 and 12%. Well, the minimum tax bracket in Canada on a provincial and federal level combined is 22%. If you can save yourself a little bit of tax, you can not have to accumulate quite as much. So there's a lot that we talk about that will influence the investment philosophy and the investment plan, but is really, it's encompassing in a way that you can control in a way that we can't control investment markets. I can control to some degree how much tax I pay. I cannot control what's happening in the market. Maybe you can with your elegant strategies, but I
can't
cannot.
control. No, I don't know where markets are going to go with any certainty. Again, I've always said, when I figure it out, you're never going to hear from me on TV.
Right.
Right?
I'm going to disappear. That's right.
Because there is no secret, right? We can always try to make a better investment decision given all the inputs we factor, but nobody knows what's going to happen. But I can tell you, on average, for the last 100 years, stocks did about 10% in the U.S. and the rest of the world around 8%. I mean, that's a fact, right? It's in the books.
And your option strategies will provide buffers, right?
So
I won't do that on my own.
If you're fully invested all the time and never look at your portfolio and just buy a low-cost index ETF that represents the world markets, over 30 years, you're probably going to get that number, right? Like, isn't that the smartest thing to do? But let's talk about risk, because people don't like to see, from time to time, we go down a lot. COVID was another example, the great financial crisis. We had a big correction in 2015 and 2018. And, when you're in your earning years, Monique, and it's always, and you're putting in and dollar cost averaging, it's different than when you're 65 and you got no more income to put in. Right now, you're in the decumulation years. So risk tolerance and your ability to take risks, talk a little bit about that in the discussion with people.
Sure. So, let's save risk tolerance for a minute. There's a couple of steps to look at first, and I've increasingly been participating in some of the onboarding of clients to ETF, and I'm actually seeing this in practice, and I'm seeing how effective it is in terms of preparing people to make that decision of how much risk to take. The first question being, what is the risk that's required to produce the return that you need to achieve your goal? That's some of the tables that we showed earlier. If you're younger and you have the capacity to save, maybe you take a little bit less risk because you don't need to generate a higher return to end up in the same place. So that's the return required. The next is the risk capacity. So to what degree are you insulated? Is your plan or your future intentions insulated from those wild market fluctuations you were talking about? Now, part of that could be because, again, if you're further away from retirement and we face a market setback, yeah, you have the capacity to maybe weather the storm and wait till markets creep back up. The other way to improve your risk capacity might be to have a really robust emergency fund. I know it's not sexy, but knowing that you won't need your money for 6 months or a year allows you not to be your own worst enemy in making those investment decisions. When you see a market pullback and you say, I don't want to sell low, but look at what's happening in the world. You're talking about earlier people who leave their portfolios alone for 30 years. People don't do that. They look frequently and they get nervous frequently. So how do we improve a client's financial resilience? Well, we give them the opportunity to create risk capacity. You don't have to worry about as much about monies that you don't need to touch soon. Again, the idea of having a robust emergency reserve. So once we've established the required risk, which the plan will produce, your capacity for risk, which again, we can provide some strategies to protect you in certain ways, only then am I even really interested in what the client's visceral idea of how much risk to take would be. So there are some people who will be very comfortable with investment risk. The people who are very comfortable with the ebbs and flows in markets and things like that. That's great, but I'd much rather talk to somebody about their risk tolerance once we've established the required return and their capacity to weather the storm.
Right. So some people have been commenting on different types of exposures to get. REITs, a good area of
Yeah.
investment for some yield seekers and total return out there. The standard deviation of the REIT index and the volatility that we saw through COVID, the drawdown there was over 40%. You know, and the average investor, from a mental standpoint, you know, can't deal with that.
Right.
So again, the question when we talk about risk and tolerance and ability, how many people in retirement can call a REIT part of their fixed income holding, knowing that you get 40% downside if something goes wrong?
Right.
So,
Exactly.
so it's a great question. It's a great observation point. I'm just not sure that I agree with that.
Can I just ask you, you know, a lot of people, sorry, one more thing. Where would you put preferred shares here? Because preferred shares are really precarious right now.
There's different types of preferreds. The market's
Yeah.
changing dynamically. There's been a change in how banks do certain tier one capital funding, and that's caused the reset preferred market to shoot up. The rest of that is behind us and not going forward. But again, if you're in a rising rate environment or a falling rate environment, those reset preferreds are going to behave differently.
Right.
And so it's not as simple as just set it and forget it. It really isn't. And again, I'm open for debate there on those questions, but I'm not sure that I agree. So again, you can ask me, where are we going to get the 8 to 12%?
Seriously.
So factually, you've got to be 100% growth focused to even have a chance at those numbers, because in traditional fixed income, government bonds, good quality corporate bonds, those numbers are not possible. So how do you get low risk and balance, you know, into your portfolios? So, you know, if you're focused on dividend paying equities and utility types, those long-term numbers aren't there. However, banks, we all like our banks. Remember, we've come through the best 30-year period of falling interest rate environment that has been very supportive for financial institutions. Here's the TSX banking index going back to 1989 and the US large cap banking index. Well,
Can I
those
assume that the
numbers,
Canadian one is the white?
the white is the Canadian one.
Yeah.
So that number has been 11.6%, and the US numbers is closer to 8. You can see where they started to diverge. It was the
Right.
great financial crisis and the housing collapse in the US that really put a big dent into the US banks and
Right. And the
Citi.
bailouts and whatnot.
Exactly. And so
Yeah.
they had to. Now, I've been in a meeting and in a room where if this crisis kind of happened maybe 6 or 12 months down the road, that CIBC might have been pulled under because they were in the collateralized loan obligations. They were getting
Right.
big into that space. I think CIBC had to write off around $3 billion in terms of a hit, and that could have been 5 times that factor. Again, had things played out a little bit differently. So Canada, we got lucky, guys. But
Seriously.
our banks are great institutions, and I have no issues with them at all. Is the next 30 years going to be the last 30 years in terms of performance on these things? I would say the dividends are good, but I think the growth aspect of it. So if you look at that number, you see the price change, and then you see the total return.
Mm-hmm.
So half of that number has been dividends, and the other half has been from change in capital appreciation.
Right.
And I would argue that dividends probably around 4% will be, you know, okay. But the growth part might be half of what it was the last 30 years.
But I do want to make mention for your listeners that dividends are wonderful, and we've all read a book about how great they are and how amazing they are to create an entire portfolio of dividends. The one thing that we often forget is that dividends, when they're reported for tax purposes in a taxable account, are grossed up by 38%. And so what that does for a retiree, so let's think again from the decumulation phase of your life, creating an all dividend portfolio to help support your lifestyle, yes, it'll be a little bit more tax efficient in the end, but it may also kick you off of old age security. And so old age security begins to be clawed back at around $79,000 in income per person, but that's the grossed up amount. So you could potentially, I haven't done the calculations right now, but you could have $50,000 in dividends and come very close to the clawback threshold because of the 38%. The dividend credit, the tax credit, doesn't come into play until after you calculate your net income, and the OAS clawback is calculated based on net income. So I've seen clients who have deliberately, again, based on a book, not listening to your show, created an entire non-registered account full of dividend stocks, only to find, mind you, it's one small income stream, but only to find that old age security is not available to them because they fall into the clawback threshold.
Yeah, so these are very important things, and they might sound small, but really they're adding to your total number, right? When you put them all together, and so I think people do need to speak with experts in these areas, and you can only get so much, I guess, for free if you think about it that way. Like, there's a lot of information out there, but really it's really worth sitting down with an expert. So what are the people doing that can do everything? So this is the CPPIB, this is the Canada Pension Plan. And I read their annual report every year because I want to see what the people who can do anything in investing, what are they doing to save for our retirement, because we're all shareholders in this, right?
Right.
Because they take our payroll deductions and the employee deductions and so forth. So 1999, big change happened.
Yeah.
So pension plans were generally an obligation of the government that basically held government debt. And in the US Social Security Trust Fund today, $3 trillion of IOUs. It's the government promised to pay.
Oh my goodness.
Okay. Now that's what a Canada Savings Bond is. That's what a Government of Canada bond is. It's a promise to pay. So assuming they can still tax and raise revenues or print money, they can pay you. So I wouldn't worry about it going bankrupt from that perspective. However, so in Canada, they recognize the challenge, falling rates, the actuarial assumption, right, based on life expectancy. So the average Canadian lives still about 82, 83 kind of thing. Monique, you model someone's life expectancy, one of the family members to live to what, 95 you use?
So we use, for women, generally speaking, 96, and for men, 94. But I do also ask clients about their family history of longevity, because sometimes we have to project to 100, or if someone has a protracted life expectancy, I don't want them to miss out on being able to spend their money. If they have a health condition, let them enjoy their money while they're well and able to do so.
Yeah. So that 7% number was the target actuarial assumption. So how does the government get that number? And this is not 8, 10, 12, right? This is 7. Mm-hmm. So look at what they've done over the years. There's very little actually today in public markets. So if you look at the change on how they've invested, it's very, very interesting. Keep in mind that this 7% target that they're working on for everybody, which includes all the people who don't make it to those numbers, right, in terms of what they're able to pay out, this gets the average couple about $25,000. This doesn't include OAS. This is just the CPP.
That's right. And it is indexed for inflation. It's valuable.
It is, for sure. So let's look at the mix. So the public equities, under 30%. The government bond piece, under 10. Okay, so the public market, what the average investor has access to, these two, very small. Private equities, private credit markets, other ways to generate much higher returns that don't include public securities. Infrastructure, real estate. These are things that people need in their portfolios today to even have a chance at getting those kind of numbers, especially those who don't want that volatility of all equities, especially public market equities. Private equity funds, their valuations move around, but they don't move around like public markets do, right? So there's opportunity, but private markets have liquidity issues. You give your money to a private equity fund, it's locked up for 5 to 7 years. You can't get it out. You can't sell it the next day. So for the less volatility that you get in those, you have to lock it up, right? But for some people, their long-term money that they're not going to need for 30 years probably should have an allocation to private equity, right? Probably should. This is why a couple years ago for ETF Capital Management, we launched a private debt and equity fund that focuses on real assets, infrastructure that have high yield. Because you can't get it in the public markets anymore. Right?
You can buy an infrastructure, you can buy a utility, you can buy a bank.
Sure.
It's these that you can't, as a private investor, as easily purchase.
Well, they have minimums, right? So sometimes you have to give a minimum of $150,000 per investment, or something like that.
And then you don't get any diversification then.
And then so you're not diversified. You're with one manager, right? So we've got a multi-manager fund. We've got 32 different managers. We have 6 different types of lending and exposure to infrastructure and real estate, right? We're incredibly diversified, right? So, and Monique, 6% or more a year.
Wow.
Right? So there are ways to get these types of numbers into your portfolio.
But they're not the traditional 60-40.
They're not the traditional way. Listen, the world is changing, right? And so we need to adapt. And you can see what the smart money has done. If you consider the Canada Pension Plan smart money, way smarter than the US pension system that still has an IOU of $3 trillion yielding 1%.
Right. So
there's more money leaving the Social Security Trust Fund than there is coming in from pension, scraping off income.
Well, part of that is demographic shift, right?
It is, because when they started all these plans, 12 people were working for every one person that was getting a benefit. And today those numbers are 3 to 1. 10 years from now, 2 to 1. Like that, there's not enough there. So, what do you call a system where you need more and more people to fund the payout, right? Charles Ponzi, I think, was the guy who started. I'm not saying the pension plans are Ponzi schemes. Maybe
the pension plans are amongst the most successful investors out there because they are thinking perpetually.
The Canada Pension Plan is, a lot of sovereign wealth funds are, but the U.S. Social Security Trust Fund is a whole different beast, and the political challenges they have. Nevertheless, their equity markets have been amongst the best returns in the world. So, okay, so let's look at some of the what ifs here. What if your inflation assumption is too low? What does that mean?
So what I did is I ran some scenarios looking again, this because it's a little bit close to my heart. I looked at a 50-year-old, how much would inflation affect someone who wants to accumulate enough to support, again, that same $90,000 a year at various rates of return. And so in this particular calculation, on the x-axis, we're looking at rates of return of 2.5, 4, 5.5, like we did before, all the way to 12. And the varying bars are actually different inflation rates. So 2.5% being, a little bit more than we're seeing traditionally over the last 10 years, but not, any sort of spiked inflation. But then I tested the waters at 3% and 3.5. And clearly with the higher rates of inflation, someone my age who is not willing to take risk would have to accumulate more and more and more capital to produce that $90,000 a year level of spending. What's interesting about this graph is, again, we see the same trend that the 2.5% inflation, you don't need to invest as much or have as much capital. But look as we go again all the way to the right to the more extreme levels of return, which you said yourself are hard to obtain. The rates of inflation at that point become a far less relevant. And part of that, my understanding is because equity markets tend to follow inflation to some degree. There's a buffer for inflation. So clearly for the more risk adverse, you're going to be subject to the ill effects of inflation far more than someone who, let's say, is more willing to take a little bit of risk, maybe even the 5.5 or 8%.
Yeah, this is why they say there's no alternative, because that safe investment of fixed income. It used to be, the rule of thumb in financial planning, when you were 60, you'd have 60% bonds, 70, you'd have 70% bonds,
Right.
80, and so forth, and that just forget it. Unless you only need 2% or 1% to live off of, right?
Right, or if you're
Never
lucky
mind
enough to have a defined benefit pension, so you don't have to worry.
Right, and those don't really exist anymore. Certainly for the next generations, you're not going to see much of that.
Yeah.
Okay, so next, what if? So your planning so far has assumed that you're going to run the money down to zero. There's going to be nothing left at the end when the last of the couples pass. What if you want to leave money to your kids or to philanthropy or whatever? What does that mean for the numbers?
So at this point, it's a bit of an old story. The more you want to leave at the end, the more you have to accumulate at the beginning too. So again, we've looked at a 50-year-old. X-axis is various rates of return. The gold bars are what you would need to accumulate at 65 were you to, like you said, exhaust all of your investment assets the day that you take your last breath. And the black bar is maintaining the state of $1 million at that, that last day, that final day. And you can see again, in the lower risk world, you do need to accumulate tremendously more money. In this particular case, $750,000 more at 2.5% if you want to leave $1 million estate. As we go again to the right, again, old story, it becomes less and less relevant, mostly because $1 million producing 8% is getting you most of the way to that $90,000 without an erosion of too much capital. At 12%, you're barely eroding capital at all. But where are you going to get the 12% from? That's the whole discussion we're having today. I
Here's
don't
our
know.
next slide here. How can you get 12%? So I want to share with you a couple of ideas. We touched on them last series of webinars when we looked at the defined outcome ETFs, the innovator ETFs that have these risk mitigators in them. They have these buffers. So a lot of our portfolios for clients, we use put protection, we use strategies so we can deliver all equity type exposure to clients and all equity type potential, but being able to manage the risk side of the volatility, not through traditional fixed income, but through the use of option strategies and hedging strategies that give you the ups and downs of a 60-40, but not have the burden of the low yield, right? So we know from looking at psychology and through the work of Daniel Kahneman and his Nobel Prize winning work that people dislike losses more than they like the gain.
Yeah, about 3 times more.
Yeah, and so the worse the losses, the more they dislike it. The higher the gain, the more. So this S curve, so the more you make, you're happy, but your level of excitement about the gain diminishes. The more you lose, the more unhappy you are, and the worse the loss gets, you get increasingly unhappy. And that curve only ends when you say, "Get me out,"
Right.
and you sell.
Right.
So depending on where you are as an individual, and this is your ability to take risk, right? We talk about your ability by way of what's your savings, what's your income, but this is your emotional ability.
Absolutely.
Right? Are you able to let your money go up and down no matter what happens, knowing that you're in the right type of portfolio to meet your goal in the long run?
Right.
And I think it's few and far between that can fit that mold. And if you think that you can trade in the market and be in one day and out the next, the studies are that if you miss the worst 10 days, your returns way above 12%. If you're able to sidestep the worst 10 days of all market declines in history, Monique, you can get 15. But here's the thing. The day after the worst day is often some of the best days.
Right.
And if you miss the 10 best days, your number is 2.
Oh my goodness.
Right? So those are the facts, right?
Right.
So trying to miss the best and worst days is a mug's game. I'm really good at this, and I don't know, right? We created the ProEye series of indicators to help us guide through the ups and downs. When do we need to get more defensive and cautionary, and when can we be more opportunistic and aggressive? It's a helpful tool,
Right.
but it isn't the panacea, and it doesn't guarantee that you're going to do this well.
So you have to be able to stomach those declines and work against your own instinct, which is to run.
You need to buy when it's low and sell when it's high. And so here's
Easier
what I do.
said than done.
So in our stock portfolio, we filter out the top 1,000 stocks in the US. We take the Russell 1000, okay? And these aren't rated for good quality and good earnings. These are just the largest 1,000 names. Then we do a screen and we say, give us the companies with the cleanest balance sheets, best value, best, trend of return on investment and so forth. So we screen for value and quality, and then we get rid of the bottom half. We say, here's the top 1,000 companies, but these are the weakest, these are the bottom half. So every quarter we go through earnings, we update the numbers, we get rid of the bottom half. And that becomes our universe. So now we have 500 US stocks to pick from across 125 industry sectors, right? We say, well, what's the best 1 or 2 in each sector, right? We kind of think, and then we do the same for the TSX and for international stocks. So now we have a universe of 800 stocks. And when I'm high conviction, maximum excitement about the name, there's good value, the analyst earning target, we think we're going to be way higher, 3% in that name. But when I'm risk averse and I want more diversification and less risk in a single security, 1%.
I see.
Right?
Okay.
0.5%. I like the name. So people call in, they say, Larry, what do you think of Restaurant Brands International? Say, great company, good coffee, right? No, I don't like donuts, right? So when do you buy it? That's the question. When do I buy it?
Right.
So I look at it.
And is that what we're looking at here?
That's what, yeah. So this is Restaurant Brands International, and I've got the earnings periods highlighted there. You can see with the green and red boxes, and that single line at the top, that's the forward analyst average consensus on where earnings are going to be. And for me, before I want to own a name, I want at least the ability to make 20% to where the analysts think it's worth, and the analysts aren't always right. But at least I want the opinion of the consensus of the pros that the upside is there.
Right.
Okay. If the upside ain't there, the probability of it going much higher is low. So at a period like we saw earlier this year, where we had already reached the target of the analysts, now they upgraded their targets after that, but going into that earnings number at the top end of our trading range, where there was no upside relative to their targets before the earnings, that was a time to take some money off the table.
Because the stock had already reached its precipice.
So I've screened the TSX companies, and I said, which ones are the good ones? Which ones have a good balance sheet? Which ones are well run? And which ones have good return on investment? And I want to own them when there's potential there, at least 20%. And then we look at all the sectors and we say, well, what's the best restaurant one? Maybe there's a better one. Maybe Darden in the US is better than QSR right now. And so maybe I own 0.5% of each, right? And I got 1% in the restaurant sector. So that's kind of how we look at them. And then you say, am I in a taxable situation or I'm not, right? And then the total for speculation account, because for people to take a lot of risk, you want to minimize taxes. That's a way to improve your return. Take all your maximum risk in your TFSA, because you're never going to pay tax on the outcome.
No.
So if you're taking a lot of risk, and the goal to take a lot of risk is to make a lot of profit, do it in your tax-free savings account.
Yeah.
right? Assuming you can fully fund your retirement accounts too and have both. And not
Right.
everyone has that level of savings, but assuming you do, that would be the smart thing to do, is to take more risk there. People treat their TFSA like a savings account, like a
It's
bank
such a
account.
shame. It's really where the greatest
Completely the wrong way to
opportunity
do
is.
it,
Yeah,
right?
it's the greatest
You've got to take
opportunity.
more risk in your registered account and less risk in your tax account, where you're paying out the income on your capital gains, and every year you got to pay tax,
Right.
right?
Right.
Where you're not taxed on your registered money until it comes out. And you're never taxed on your tax-free savings money, right? So
No,
we
and it's
want to,
actually a great sprinkling strategy where we get clients who are over age 65. Again, not the ones who are the tens of millions of dollars, but the what I like to call the worried wealthy. And every bit counts. And so if again, old age security is something that they want to spend some time on, not everybody cares, but if they do, then there's some great strategies whereby, yes, you take some money from a registered account, you take a little bit of money from a non-registered account, and you still need more, but you don't want to exceed the threshold. You take money out of the TFSA because the TFSA on the withdrawal end is non-taxable, doesn't
right?
affect your old age security. So
Exactly.
there's all sorts of great drawdown strategies and what we call tax effective harvesting.
Exactly, and that expertise comes from spending time with people like you who know those things. The pink line at the bottom there, that's the relative performance of QSR compared to the benchmark, the S&P 500 I use as my benchmark. So QSR has actually been underperforming for months now, right? It's trend. Well, now it's starting to get cheap, right? So this is actually one now that's come on my radar. So my first leg in of 0.5%, right? Now this could keep getting cheaper, right? So I like to see what the analysts say, where are their targets, when's the next earnings date coming up, what does the company say about that? But right now, this is looking kind of attractive to me if that's a name that you like, and this is on our radar in our stock portfolio right now.
I'll keep it in mind.
Okay, Alibaba, right? You've heard me talk about the Chinese internet stocks on BNN. And so here's an example of that same looking chart, and why earlier this year and late last year, I was really bearish on these and said, you got to get out of them. Well, people who are momentum driven and like buying high and selling higher hated me. I got a lot of hate mail, right? When I say things like that. Now that China's not investable, this is a name that's really attractive to me.
Right.
Now, again, there's issues there, but this is part of buying when there's blood in the streets. So you kind of want to look at the big picture. And if I look at a 5-year trend, right on trend here, we're at the bottom of that long-term 5-year trend, right? So this stock, there's some value there. There was absolutely no value relative to price targets when we got above that trend. That is not a good time to buy the stock from a risk reward perspective. And I'm all about, I like the name, right? So again, we filter for companies we want to own, and then we look at them as they go through their ups and downs as to when we add to them and when we take away from them.
But emotionally, most people would be buying when?
Well,
Probably
when it's
May of
high, right?
2020. May of 2020.
They're buying usually when it's doing well because all the
Yeah.
news is good.
Yes,
So at
exactly.
some point, all that news gets priced in. And that's the thing. We don't know when that's going to be ever, but I can measure it statistically. I can look at trends and deviations and make an assumption based on, what our analysts think it's going to be worth and so forth. And you can
It's
see
lonely being a contrarian,
it
Larry.
is. The closer we get to those analyst targets, the worse the risk reward is. The further we are away from those analyst targets, the better the risk reward is. But you could argue that for months now, that risk reward keeps getting better and better and better. And that analyst target is actually falling now as the news in China. So the analysts are often behind the curve too. That's something to be concerned about. And really adjusting positions here. So again, we're looking at BABA, but now we're looking at a different time frame. So that was a multi-year picture of BABA, and it looks really good. And now when we blow it up and look smaller term, it looks like a bottom's coming in now. So I actually own BABA. I added to it when we got to the bottom of the bands a few weeks ago. And actually yesterday, I blew out my entire position. And as it comes back, I'll start adding again. Again, as the risk reward improves, then we adjust our positions. 0.5%, 1%, 1.5%. If we like it and we have high conviction, 3%. Right? So I own 30
That's on the
names.
high end of your
When I'm maximum bullish,
concentration.
that's going to be
Wow.
the biggest position I'm going to have in a name in our portfolios. Let's talk about ETFs. So what ETF are we looking at? I like thematic plays. I've been talking about uranium. I've been adding and subtracting to uranium. So uranium got to the top of the band in May and June, and we were reducing our exposure. I like it. I still think for years uranium is going to be great. But look at that correction. It went from like 27 down to under 20. Well, now it's at the bottom of our bands again. Risk reward improves. As long as you like it fundamentally, as long as the reason to own it is still valid, you got to trade around that position. So we added to it. Literally a couple weeks later, this thing explodes to the upside. We took some off again. Got back to the median. I added some. I just trimmed my position in Cameco. I cut it in half today. It was 1%. At the low, it was 1.5. I cut it to 1. I brought it back to 1 at the median. I now cut it to half again. Get a pull back to the median, go to 1. It goes to the bottom, I go to 1.5.
Right.
If I really had conviction about this space, I could make that 2, 2.5, 3. But I like it. I don't love it.
Yeah.
Wow. Right. So again, uranium as a broad
But people
way to play the
can't.
sector.
Most people can't do that in an entire portfolio. They
Well,
can't
again, I'm just showing
buy
you
a
some of
big
the
enough
ways.
position. But we need to participate in.
Well, so that's a factor too for people. How big is your portfolio? How diversified can you be in trading in board lots and things like that? Those are factors too. Here is another ETF. This is KWEB. This is Chinese internet stocks. Again, a few months ago, guys, you got to avoid this. Got the hate mail. And now I really like it. I think there's value here. So again, long-term perspective, here's something that I like. So you say, Monique, where can I get 12? Uranium was a space to get it. Chinese internet now is now a space to get it. QSR, potentially a stock to get it. So there are stocks at times that have that potential, but not when they've already reached their price targets and their maturity, and when they're overvalued or overbought. You just got to trim them and look for somewhere else to get that money. So it's
you have to be far more active than you used to have to be.
Listen, you can use ETFs, but using them passively is hard to get that number.
Right.
And I'm not saying go to cash. I'm saying I'm selling KWEB up there and I'm finding another thing to put that in. Right. And it could be the S&P 500 or it could be something else, right? Where there's an opportunity. It could be a sector, it could be a part of the world, could be a country, could be a certain currency exposure, could be commodity. My most frustrating trade has been gold, right? The gold equities has been terribly frustrating for us, right? So gold here. This is Brazil. This is a Brazil ETF, and I really like Brazil. I think the value is compelling. They've got a terrible leader. He's being brought up on criminal charges for crimes to humanity and how he dealt with COVID in Brazil. Their supply chain, they're the food provider to the world. Catastrophic story. You got to think a lot of bad news is priced in there, right? Meanwhile, I've been adding to Brazil, and every day it goes down a bit more, a bit more, a bit more. You got to remember when you're investing in international markets, currencies, and exposure, you have to think about the Brazilian real relative to the US dollar, and those things come into play as well. But Brazil I like right now, and I think if you think about where can I get 12% plus over a year or two on average, Brazil right now makes a lot of sense to me. So I think you need to be active. I think you need to learn how to hedge. You need to use option strategies. Your fixed income needs to be in other areas that aren't traditional fixed income. And your 60-40 portfolio ain't going to cut it for you, you know, for the next decade or so. So it could be longer than that. Anyways, we're out of time tonight, Monique. So thank you so much. Yeah, an hour and a half gone by so quickly.
Wow, that was
terrific. Thank you so much for your conversation, and I hope people online really got something out of this, and maybe, you know, a different way to think about your investments and how you go about do what you're doing. So So again, Monique, thank you very much. Please reach out to us at UPotential, and Monique would be happy to do a consult with you on your specific needs. And again, if you can support one of our charity partners, cancer research at the Sick Kids Hospital, and leukemia in particular, and dementia and Alzheimer's at Baycrest, we'd greatly appreciate it and look forward to matching your contributions. Thank you, everybody. Have a great week. Next week, special guest, David Rosenberg. We're going to talk about interest rates and everything else going on in the world for those of you who have that focus and want to know what's coming up in markets. Have a great week, everyone.